In this video, despite the new Zelda game dropping yesterday, here I am once again, another daily YouTube video. That's how much I love you guys, and/or that's how much AG1's helping me get a lot more out of the days. So in this video, we're going to be looking at some new research from Morgan Stanley, which is actually fairly on point. In short, we can see some clear signs of the current collapse, implosion of the automotive industry, including legacy, and some very scary signs for electric vehicle startups. A clear winner, obviously Tesla, but things do not look pretty for any company producing vehicles of any kind if their name isn't Tesla, and yet there are a few exceptions in China. But outside of that, the shit is really hitting the fan. Mark my words, most of today's automotive companies won't be in business by the end of this decade. The biggest winner will be Tesla. The biggest loser, the rest of the fucking industry. This video is likely to age rather well. Who says that? Oh wait, the guy that knows it's likely to age rather well, that's who says that. Keep me accountable. By the way, massive thank you to everybody who subscribed over on Twitter. Dropped another exclusive video yesterday, this time explaining how Twitter dating could massively disrupt traditional dating apps. And we've officially cracked 1,000 subscribers in less than a month. In fact, let me check right now. Nice. 1,069. So thanks to every single one of you for the support. If you're not subscribed over on Twitter, you're missing out on a load of exclusive content you'll find nowhere else. And yes, that's right. I'm still continuing to produce exclusive content available only to my Patreon supporters as well, including an archive of over 300 videos, access to my Tesla fair valuation, formerly known as price targets, and optional access to my valuation model as well. I am a busy fucking boy. If you don't want to miss out on any content, click the links to the pinned comment and subscribe to Twitter, join Patreon, and I'll see you over on one of those platforms. Or don't. I ain't going to be mad. You can just keep watching the daily videos here on YouTube. There's no skin off my nose. Morgan Stanley really can't stop talking about Tesla. Turns out we have a lot more in common than I realized. EV profits lack the wow. A closer look at then versus now. Oh, look, it rhymed. EV adoption will increase. That's clear. Well, so far so good, Morgan Stanley. I agree. But expectations on margins and economic returns have moved sharply lower over the past 12 months. We await a recalibration in strategy from Tesla's competitors. We take a closer look at our 2023 earnings forecast from our 1 year ago published models of Tesla, Rivian, Lucid, and Fisker compared to our 2023 expectations exiting this most recent quarter. A few thoughts. EV profitability is an important and too often overlooked factor driving capacity and capital allocation decisions. Today's in-force EV capacity and product expansion plans were largely decided in 2021 and 2022. During a far more bullish outlook for margins and capital cost, a significant gap has opened up. Well, you can't tell from today's press releases. We're pretty sure you'll see a change of tone or recalibration of incremental spending plans become more evident toward the end of this year. To the best of my understanding, Morgan Stanley here are insinuating that many companies with lots of plans to produce electric vehicles are likely to ease up on investment, to ease up on the speed at which they attempt to transition to full EV production. They may be right. However, this would be a fatal error from legacy automotive companies. To expand a little bit more on what Morgan Stanley are discussing here about the EV forecast 2021, etc., regarding margins, capital costs, and so on. There are a few folks who seem to ignore reality and don't know what words mean, who saw Tesla's prices increasing substantially and temporarily. You know, the same prices that Elon Musk literally described as embarrassing. Yes, embarrassing, as in they're way too fucking high. It's so ridiculous that we're embarrassed by how expensive our vehicles are today. And many onlookers thought, oh, that means margins for all electric vehicles are going to be this high forever. And now, as margins come back to reality a little bit, folks who were living in La La Land thinking that unsustainable, embarrassing prices would last forever are realizing, oh, maybe EV margins won't keep going up forever. However, once again, everyone seems to be missing the forest for the trees. There'll be bumps along the way, but the cost to produce compelling electric vehicles will decline precipitously throughout the decade. We know this. Battery costs are declining predictably. EV costs are declining predictably as global production increases. It's a new technology. Lots of innovation still yet to take place in terms of how to manufacture these things economically, fast, and therefore cheaper. End of this decade, companies like Tesla will be producing vehicles as good as or better than today's Model 3 or Model Y, and their cost to produce those vehicles will be less than half the cost it is today. I harbour a very strong suspicion that these vehicles won't need to be sold for half the price they are today, meaning that margins are actually going to be a lot higher than people are expecting. This to me seems self-evident. If the prices keep coming down way beyond the point where they need to sell through insane amounts of production, at some point, margins will actually creep higher and higher as costs come down. Time will tell, but I think a lot of people are really missing a trick here. Tesla's setting prices closer and closer to cost. don't expect this to change. Expectations around Tesla's pricing strategy have changed materially over the past year. They're right, but the fact that expectations have changed, obviously people weren't listening. As Morgan Stanley continue, we see Tesla's pricing posture both as part of Elon's master plan. Round of applause to Morgan Stanley. That's right, it is in their master plan, that 17-year-old thing they posted on their website explaining the costs come down, affordability increases, more electric vehicles are sold, thus they accomplish their mission, and are reflecting of the big changes in supply and demand in the global EV market. Look no further than Tesla Lithium. Tesla is the only OEM to vertically integrate into upstream lithium refining. In our opinion, this only works because Tesla is the only player who can guarantee the volume offtake. Now, they may have a point here. Tesla has compelling products, insane pricing power. Obviously, they'll sell every vehicle they make. I've said this many times. This is my very strong opinion. To be clear, they won't sell every vehicle they make at today's prices, but remember, the costs are coming down. They can pass those cost savings on. Next minute, they sell all the vehicles they produce throughout the whole fucking decade. However, I have a controversial take. I think at least for the next few years, even really fucking average electric vehicles, which will be sold for catastrophic losses. But from a customer's point of view, they don't care. They just care what they're paying for the thing. Not whether or not the company producing them is going to go bankrupt because they can't sustain those losses competing with Tesla on price. But I think even very, very average, competitively priced electric vehicles will sell. It doesn't matter who's making them. We're at a tipping point now. We're seeing a massive global mind shift in consumer expectations and what they're considering. Latest surveys, depending on who you're asking in what markets, 25, 30, 40, 50% of consumers now either thinking about or adamant that their next vehicle will be an electric vehicle. And this is obviously an evolving situation. The more electric vehicles are sold, the more neighbors, colleagues, friends, family. Hey, you got an electric vehicle. I thought that was shit. How do you charge it? Next minute, they see how these things work. Their neighbor goes, oh, well, actually, it's like half the cost to own and operate. I did the math on it. It's actually going to save me a lot of money. Oh, really? I didn't know that. I might buy an electric vehicle. Long story short, a few years from now, most consumers will be adamant that their next vehicle will be electric. A few years after that, practically every consumer on earth will be thinking, there's no way I'll buy an ICE vehicle. My next vehicle will definitely be electric. Make electric vehicles, price them competitively, and they will sell. Of course, pricing them competitively will lead to bankruptcy for many legacy automotive companies, but hey, that's their problem. But in order to guarantee the volume offtake, Tesla must be willing to potentially set the lowest level the market will allow. This price may be far lower than that contemplated in competitors' EV expansion models. Now this, ladies and gentlemen, is what we call the facts. Let me explain. I don't think any of Tesla's competition has any idea. I don't know how they don't have an idea, but I haven't seen any indications that they do. I don't think I have any idea how dramatically, how precipitously EV costs are going to decline this decade. I've run through this exercise in the past. According to Wright's law, with electric vehicles, for every cumulative doubling in production, we see about a 28% cost decline. We need more than 3 doublings of global EV production to reach 100% market penetration for electric vehicles. In other words, by the time electric vehicles are 100% of the new vehicle market, which I personally believe is going to happen, give or take, within a decade, there'll be a long tail, but 80+% is really the mark to focus on. The cost to produce those vehicles will be about 1/3 today's current cost. I don't think legacy automotive manufacturers are modeling average selling prices of $18,000, $20,000. So Morgan Stanley have a point here, although I don't think they really understand how cheap these things are going to get either. Per the earlier comments about prices declining and margins, I don't think most people are realizing the implications here. As I said, EV costs are going to continue to decline far lower than they need to sell through 80+ million electric vehicles per year. The margins on these things toward the end of this decade, there could be manufacturers like Tesla with 35, 40+% hardware margins on the actual vehicles themselves. Now, I'm not saying that this is Tesla's plan, but let's say 2030, Tesla's only producing a mere 20 million vehicles per year, give or take. And let's just say that there's a lot more demand than 20 million vehicles for Tesla's products. Tesla's going to need to price their vehicles at a reasonable level such that consumers ordering them don't have to wait absurdly long times to actually take delivery of their vehicles. I don't hear a lot of people talking about this. Most people, after Tesla's recent earnings, go, oh my God, Tesla margins are collapsing. They'll never be above 20% again. Oh my God. I don't think those comments will age well. Let's just leave it at that. Tesla shareholders should ask themselves, what would happen to Tesla's volume sequentially if they did not cut prices across the range as they have? Would they deliver in volumes equal to their capacity to produce? Would Tesla be burning cash if they didn't cut price to support current volume? How much more can Tesla cut? On a 2024 earnings base, we calculate a 10% volume cut, which is 30% decremental margin plus working capital and other factors, could drive reduction in cash flow on the order of 3 to 5 billion. On our calculations, a 20% cut to 2024 volume could remove substantially all of our current $10 billion 2024 free cash flow forecast. I noticed a distinct lack of Morgan Stanley acknowledging that Tesla continues to reduce the price to actually produce their vehicles. I don't get it. Hello guys, if the costs come down, prices can come down and margins can actually go up. I guess my IQ is a few too many standard deviations below Morgan Stanley's, therefore I just don't understand what they're talking about here. It seems like they don't acknowledge there's a lot of moving parts. It's just like, oh, well, everything's going to be exactly the same as it is today in the future, therefore we can make some assumptions and we're very smart. Have a look at the following charts. Some things that caught our eye on the change of our 2023 forecast from 12 months ago today. Tesla, Rivian, Lucid and Fisker all have seen negative revisions over the past year. Of the four, Rivian is the only one where our 2023 operating margin was not revised downward, thanks sharply lower OPEX versus our prior year forecast. Revenue was revised down for all four except Rivian, where we had already expected volume constraints from supply chain bottlenecks. We're well below consensus on volume forecasts across the EV names we cover, especially for Fisker and Lucid. Got to give credit where it's due, Rivian are doing pretty well. I mean, they still may go bankrupt, but at least they're producing vehicles at reasonable scale. Compared to the overall automotive industry, they're a spec, but they are still moving in the right direction. Can't say the same for companies like Lucid and Fisker. I mean, don't even get me started. As for Tesla, a year ago, Morgan Stanley expecting Tesla to produce 2.23 million vehicles in 2023. Now, they're at 1.8 million vehicles. I suspect this is predominantly not on the back of them thinking, oh, Tesla's going to ramp production slower than we thought, but instead, I don't think they're going to be able to sell all the vehicles they were planning on selling. Oops. Now, personally, unless Tesla catastrophically fucks up, I expect probably 2+ million vehicles delivered for the full year. It's hard to know exactly because multiple factories are ramping and the speed of that ramp can have a massive impact. Shanghai is approaching 1 million vehicles per year. It's pretty much maxed out now, although they will continue to eke out more capacity. Fremont's close to maxed out as well. Full capacity about 650,000 a year, but obviously there'll be downtime, repairs, maintenance, upgrades, etc. So they won't produce that many vehicles at Fremont. Austin and Berlin, however, are the two big wildcards, already each around 5,000 vehicles per week. Call it 250,000 vehicles per year each at this point in time. Now, obviously, I'm recording this in May. Earlier this year, Tesla wasn't at those rates, but throughout the rest of the year, they're actually going to increase their production rate. So let's say, I think it's pretty conservative to expect at least between Austin and Berlin, at least 500,000 vehicles for the full year. Shanghai, give or take around the 1 million mark, call it 1.5 million. And then we've got Fremont as well. Unless Tesla really fucks up or the ramps in Austin and Berlin happen a lot slower than expected, it's going to be pretty difficult to imagine Tesla coming in short of 2 million vehicles for the year. On Tesla, it is our working assumption that Tesla will sell virtually every vehicle it can produce. Wow, look at this. Another round of applause for Morgan Stanley. I think they are copying my homework. No, I'm just kidding. But they said it. I've said it. I mean, hello. Tesla will sell every vehicle they make all fucking decade. Why? They got pricing power. They got compelling products. They won't be selling them at today's prices, but they will be selling them. That is my assumption as well. I'm pretty surprised to see Morgan Stanley put this in a piece of research, but their words, not mine. I mean, they're also my words, but one more time. It is our working assumption that Tesla will sell virtually every vehicle it can produce. I think they're finally starting to get it. As capacity continues to expand in Berlin and Austin, recently hitting 5,000 a week, we'd expect this to drive further downward moves in pricing. Yes, obviously. They're starting to get it. And now, Exhibit 2, 12 months ago versus current revenue estimates. 12 months ago, Morgan Stanley had Tesla at 126 billion in revenue. Now, under 100 billion. Rivian, around 3% that amount, give or take just over 3 billion. Lucid, under 3 billion. That was 12 months ago now. Oh, you did not like to see this. Less than 800 million. Yeah, Lucid are having some serious problems. It's not that their products aren't great. I mean, there's some great engineering in there. When you've got insane budgets, you can do some pretty cool stuff. The problem is there aren't that many consumers out there right now willing to fork over big bucks just to signal to the world that they're better than you. I mean, just to buy a really high-end luxury vehicle with unicorn tears in the wiper fluid and woolly mammoth pubes for the stitching of the seats. Lucid's supposed plan from day one, after they copied Tesla's, was to eventually get to the mass market, but you can't get to the mass market if you go bankrupt on the way. It appears at this point in time, Lucid cannot sell their vehicles. You know why that is? Because Tesla has a Model S and X, which are significantly better value, and of course, a Tesla Model S or X doesn't have the same ability to signal to the world that you're definitely better than them. But if you're looking for a high-end luxury-esque vehicle, you look at a Lucid, you look at a Model S and you think, do I really need to spend that extra money for the Lucid? And that really boils down to how insecure am I? Am I very insecure? Yes, well then buy the Lucid. Am I not insecure? Is my vehicle more practical than it is to signal status? It is, well then I'm going to buy the Tesla. We'd expect Tesla production tax credits from the Inflation Reduction Act, just shy of $1 billion this year, growing to $4 billion by 2025, and nearly $10 billion later in the decade, will be reinvested in lower price for consumers to drive EV adoption and industry consolidation. Well, duh. Exhibit 3, 12 months ago versus current gross profit margin estimates. A year ago, Morgan Stanley had Tesla at 24.6%, now 18.3%. So just a quick caveat here. To be fair to Morgan Stanley and everybody who's made assumptions about Tesla margins and other margins, I don't think there were too many people that were expecting the Fed to just go fucking ballistic raising interest rates. I'm still scratching my head here thinking, hello, what are they doing? Seems the Fed is intent on causing a recession in the United States, which will affect many other parts of the world as well. Automotive industry is very cyclical. During a recession, one of the last things consumers are thinking is, I'm going to buy a new car. When you're concerned about being able to pay your mortgage, losing your job, blah, 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 a lot of consumers can delay purchases. This is putting pressure on companies across the board now. It's not because demand has disappeared, but consumers who did want to buy an electric vehicle, a new vehicle, are thinking, yeah, maybe let's wait till the shit's not hitting the fan. So between now and then, give or take maybe 12, 18, maybe 24 months worst case when we get out the other end of this, automotive manufacturers will probably need to be a lot more aggressive with pricing just to continue selling through production. But this isn't an indicator of long-term trends. It's important to understand. Like I said, give or take 24 months from now, I think worst case, margins on Tesla vehicles will probably be back in the mid 20% range. Maybe the recession's worse than I expect, but this is my working assumption. I think a lot of people are going, oh, margins were below 20%. Therefore, they're never going to get above 20% again. Remember, the costs are coming down. The shit's hitting the fan. And those consumers who are delaying the purchase of a new vehicle haven't decided, I'll never buy a new vehicle again. They're just thinking, let me get through the other end of this so there's less uncertainty. That's when I'll pull the trigger on a new vehicle purchase. So I expect there's actually going to be a surge upward in electric vehicle prices, particularly from Tesla on the tail end of this recession. Once consumers who were previously like, I'm not going to, not now, I'll wait, decide it's time to pull the trigger. For contrast, a year ago, Morgan Stanley were expecting Rivian's margins to be negative 24%, and now they're expecting them to be negative 54%. Awkward. Lucid, oh boy. A year ago, Morgan Stanley had Lucid doing 8% gross profit margins, now minus 125%. A year ago, Morgan Stanley had Fisker at 6%, and now they're negative 14%. By the way, it is pretty rough timing for EV startups and legacy auto companies. Hitting the fan, recession fears, couldn't have come at a worst possible time. We're going to see a massive consolidation. And honestly, this is a good thing. Survival of the fittest. From 2019 through 2022, while money was abundant and supply was scarce, investors witnessed a rapid proliferation of EV enterprises and business plans. We expect the next chapter could see a consolidation. Yeah, no shit, Sherlock. Survival and success may not merely be dictated by who is the biggest or the richest company, but who is the most able to adapt to the changing environment. They're right on the money, including the willingness to wait it out and to operate within the limits of a company's abilities. We have drawn lessons from Adam Smith, Charles Darwin, and Warren Buffett to help guide our thoughts on the next chapter of the EV story. FYI, I covered this a few days ago. And now, 12 months ago versus current operating margin estimates. A year ago, Morgan Stanley had Tesla at 12.1% operating margin, today 10.5%, industry leading. Meanwhile, Rivian bleeding catastrophic amounts of money. A year ago, negative 164, and now negative 149. Lucid, a year ago, negative 50%, give or take. Oh, God damn it, dude. I shouldn't laugh, but bro, I've called this 1,000 times. Negative 325.3% operating margin. Don't worry, I'm sure everything's going to be fine. Lucid aren't going bankrupt, and I'm totally not being sarcastic. And finally, Fisker, a year ago, negative 29%. Today, negative 53.5%. Now remember, as Tesla recently began reducing prices, out of nowhere, people started claiming it's all over for Tesla, the competition's coming, blah, 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 blah. There's demand issues. EV demand is collapsing. And repeatedly, I've highlighted the fact that it's so important to look at the broader automotive market. Tesla can survive a recession, a very drawn-out, brutal recession. Few other automotive manufacturers can. Few others have the cash. Most others have insane amounts of debt, much of it through financing secured to assets whose value will collapse in the next few years. While Tesla may temporarily suffer slightly lower margins than people were expecting and make a few billion less dollars per year in annual profits over the next couple of years, they will survive and they will gain share. The same cannot be said for most legacy automotive manufacturers and most EV startups. This is going to be financially catastrophic. I don't think most investors can see the writing on the wall, but I just wanted to flag that now. Successfully ramping up a new EV company to profitable volume production, already a near impossible task. Doing so when the shit is hitting the fan, there are legitimate recession fears, interest rates are through the roof, people are struggling to pay their mortgages. Probably doesn't end well. The same is true for legacy automotive companies who foolishly thought that they'd be making insane Tesla-esque profits on their electric vehicles from day one, and who still today moronically think that they'll be selling and making profits on ICE vehicles later this decade, some even into next decade. That ain't gonna happen. So once again, the summary of today's video is, don't worry, everything will be fine if you're Tesla. It both amuses and disappoints me to no end to see that most folks are really missing the writing on the wall. I'm continuing to listen to commentary, interviews, podcasts, looking at research from Wall Street, automotive industry. Still today, most of these so-called experts, many who've been in the automotive industry themselves for many decades, genuinely believe that legacy automotive manufacturers will still be in business at the end of the decade, that some of them have a credible chance of catching up to and then exceeding Tesla on any metric, pick it, whether it's unit volume, whether it's profitability, doesn't matter. Not going to happen. Many investors out there in the marketplace still think any of the electric vehicle startups have a better than 3% chance of surviving the decade. In fact, a lot of these folks seem to think it's all but guaranteed. Folks continue to ignore the fact that the cost to produce electric vehicles will plummet. 10 years from now, give or take, it's going to be about a third as much to produce a compelling electric vehicle, comparable to today's Model 3 or Model Y. Even in the worst case, if it was 50%, just half the price. Think about the implications, particularly on margins. So much discussion about prices coming down, yet very little discussion about costs coming down at the same time. People are really missing a trick. It's as if people are either unaware there's a lot of moving parts, or maybe they are, they just don't want to actually use the brain to think about them and figure out the implications. Big mistake. As I've been reminding everybody recently, it's really important to use your brain, even if it hurts. Athletic Greens AG1 has given me a massive, meaningful boost in energy, allowing me to do a lot more every day, including using my brain more and using my body more. I highly recommend you guys and girls check it out. Athletic Greens AG1 is an excellent way to fill in nutritional gaps. It's got 75 high-quality vitamins, minerals, and whole food source nutrients, plus prebiotics and probiotics and digestive enzymes and adaptogens to help you deal with stress. Plus, if you click the link in the pinned comment or head to athleticgreens.com/SMR, you can get yourself a 1-year free supply of vitamin D3 and K2. But don't take my word for it. Here's what some of you guys and girls have to say. AG1 has changed my life. I was, as you described, treating myself like a circus, ate like trash, rarely exercised, used alcohol as a stress crutch, cannabis also. AG1 is what gave me the kick in the ass, got me back to the gym, motivated me to do more for myself, family, my business, etc. Keep doing what you do. Now, I know there's some skeptics, the same kind of people who think Elon Musk is a fraud, reading this going, what do you thought? There's no way that's possible, bro. It must be a placebo effect. Believe it or not, this is a recurring theme. If you give your body everything it needs to feel and perform its best, including having a lot more energy, you'll need ways to use that energy. For me personally, that includes more exercise, moving my body more social activity, and more cognitively demanding tasks, including producing a ton of exclusive content over on Twitter and on Patreon, plus my daily YouTube uploads. The proof's in the pudding. On to another testimonial from a viewer of this channel. SMR, you asked me to provide feedback on AG1. Here it is. It has helped with mental acuity, stamina, and intestinal waste management. Can't read between the lines. Certainly helps with regularity and digestion. That's what the digestive enzymes are for. It has also dramatically reduced my cravings for sugar. You guys need to stop eating sugar. It's fucking poison. I'm 50, 5'9", and overweight, aka a fat motherfucker. I think that's a technical term for overweight, isn't it? Is it fat motherfucker or obese? I can't remember. I average 100 hours a week in the West Texas oil fields as a safety supervisor. Jesus Christ, dude. No wonder you're struggling to keep your weight under control. 100 hours a week. Brutal. It has helped me lose weight. It is not an appetite suppressant. It can help fat people suppress cravings, and motivation to be healthier is critical for changing your diet. Love you, brother. Again, this is a great point. It's something people really don't seem to grasp. If you have more energy, everything becomes easier. It's like turning on easy mode for life. A few years ago, before I was taking AG1, my health was trash. I was struggling to get through the day, had afternoon fatigue. The last thing I wanted to do was either use my brain or move my body. Didn't have the energy. Now, my biggest struggle every day is figuring out ways to use that energy. I'm exercising way more, doing a lot more with my friends and family, and of course, my work output has increased substantially. And you can fact check me. Check out the average length of my videos I was posting to YouTube 3 years ago. Need I say more? And one final testimonial. Love this one. Okay, here's the deal for me with this AG1 shit. I'm 41 years old and not the type to eat, drink, smoke, or sleep healthy, so I was skeptical. That being said, here's what I experienced. Day 1, meh. Day 2, afternoon fatigue was about 45 minutes late. Day 3, 0 afternoon fatigue. Day 4, 0 afternoon fatigue plus extra energy. Day 5, again, 0 afternoon fatigue plus energy, wondering, what the fuck, really? See, this is the thing, right? The results for many people are just almost too good to be true. This is the same experience I had. My afternoon fatigue just vanished out of nowhere. I'm like, wait, what the fuck? Why am I not tired in the afternoons anymore? Surely, it's not that AG1 is it? Turns out it was. Day 6 and 7, same thing. Day 8, same thing. Plus, I had the want to get things done around the house that I normally would slack off and not get done. Again, the point, extra energy, you'll need to use it, you'll find ways to use it. Day 9, 10, and 11, and today is day 12. I fucking love it. So however you managed to get me to buy it, I'm so glad you did. Thank you so much, SMR. It really changed me so far. Guys, this shit really works. Just try it. By the way, this is the reason I continue to relentlessly promote AG1. A lot of people get real fucking mad in the comments. Oh my God, Snake Oil Salmon's sold out. Oh my God, he's a scammer. This is fraud. But constantly, I'm pretty sure everyone making these comments is also currently short Tesla stock. I'm not particularly concerned about people having a negative perception, those folks suffering from small brain syndrome, still living in my bum's basement syndrome, etc., writing mean comments, claiming AG1's a scam or it doesn't work. I mean, bro, when I get feedback like this is what keeps me going. And remember, there is a 90-day money-back guarantee. There's nothing to lose here. Just try this stuff for a month, and if you don't get these results, get your money back. See, it's a literal no-brainer. It's an IQ test at this point in time. Testimonial after testimonial after testimonial like this. Get your money back if it doesn't work. Just try it for a month, and if it doesn't work, get your money back. Today's the day. It's finally time. Be like this guy who was a massive skeptic, but finally, after 1,000 promotions in a row, caved in, tried AG1, and has results like this. Head to athleticgreens.com/SMR or click the link at the pinned comment, and please, let me know how you're feeling in a few weeks' time. Now, if you'll excuse me, time to put my extra energy to good use. I'll be recording some more exclusive content for Patreon and my Twitter subscribers. So click the links in the pinned comment. See you over on Twitter and or Patreon, and don't forget to grab your AG1. Love ya.